Hey there, Wealth Masters! Welcome back to Master Wealth. If you've ever wondered how to grow your wealth, make smart investment decisions, and secure your financial future, you're in the right place. In this video, we're diving into a $10,000 portfolio strategy for 2023, so you can get a head start on building your financial success. Don't forget to subscribe and hit that notification bell to stay updated on all things wealth building. Let's get right to it. On February 19, 2020, the S&P 500 index reached a local peak, but just over a month later, the market experienced a substantial 34% decline, triggered by the initial signs of the epidemic. This abrupt market downturn left many investors pondering the possibility of profiting from perfectly timing the market's lowest point. This curiosity is not unfounded. Taking a look at the end of 2020, if an investor was lucky enough to enter at the lowest point, their gains by the end of 2020 would have exceeded a remarkable 65%. While numerous resources are available for those seeking to deepen their understanding of investing, the consensus among experts leans heavily toward the notion that experience holds greater value than sheer luck in the realm of wealth accumulation. Delving deeper into this subject, we've uncovered various studies, including the most recent one, published in 2019. What we unearthed was nothing short of astonishing. The study's research spanned from January 1, 2009 to December 31, 2018. Within this time frame, a hypothetical investment of $15,000 in the S&P 500 over a decade yielded a final sum of $41,625, marking a substantial 2.775-fold increase in the initial investment. However, had the investor missed the 10 best performing days during this period, the investment would have grown to a still impressive but less substantial $25,875. This highlights the profound impact of capturing the market's most exceptional days. Even missing out on just a few of these peak moments could lead to a significant loss, as exemplified by the $15,750 that would have slipped through fingers in this scenario. Remarkably, had the investor missed 30 days, the initial $15,000 investment would have dwindled to just $13,725, underscoring the potential for an investment setback. This starkly illustrates that our ability to seize the market's best days plays a pivotal role in shaping our portfolio's long-term performance. As we look ahead to the year 2023, we're eager to share our insights on constructing a secure and well-rounded portfolio, a topic we'll be delving into in today's video. Our portfolio framework for this discussion leans towards a conservative strategy grounded in a long-term perspective. The rationale behind this approach stems from several significant factors: the impending rise in interest rates, a tightening monetary policy, and concerns about a potential recession. These considerations have led us to craft a strategy that not only safeguards against uncertainties, but also positions us to capture growth and build wealth. It's worth noting that this strategy has been tailored for the year 2023. We'd like to emphasize that this video is primarily intended for our audience comprising individuals between ages of 18 and 40 with relatively stable income sources. If you find yourself beyond the age of 40 or nearing retirement, it's advisable to assess your risk tolerance and explore potential adjustments to better align this portfolio with your specific needs. This becomes especially crucial for those closer to retirement. Should you have any questions, feel free to share them in the comments section below. We hope this discussion will provide valuable insights as you navigate your financial path. That being said, we're not a financial advisor. We make videos for fun. This content is for informational purposes only and is not intended as personal investment advice, tax or legal advice, as an offer or solicitation of an offer to buy or sell. It's best to make decisions based on your own research. We just hope to give you a perspective to think about. Now, let's get into the core of our portfolio strategy for 2023. Cash will be a key priority at the beginning of the year, with our goal being to allocate at least 30% of our portfolio to cash. This represents a significant shift because in the previous year, we would have held only 10% in cash. The reason behind this increase is quite straightforward. The market is currently shrouded in uncertainty, primarily concerning the Federal Reserve's actions. We're aware that the Fed intends to continue raising interest rates through what seems to be 2026, indicating a significantly tighter monetary policy. Hence, by maintaining a cash position, we're well positioned to wait for favorable market opportunities. Our strategy involves refraining from deploying this cash until the Federal Reserve signals a halt to interest rate hikes, or possibly even hints at rate reductions. It's essential to recognize that market outcomes can vary, and your cash allocation may differ from ours based on your individual circumstances. As always, the adage that time in the market beats timing the market holds true. If you prefer a more extended investment horizon and wish to remain fully invested, that's a valid choice as well. To reiterate, our portfolio strategy for 2023 is inherently cautious, emphasizing a long-term perspective, targeted aggression where appropriate, and conservatism in other aspects. This is why our cash allocation stands at 30%. Now that we've covered the basics, let's dive into the exciting part, discussing the actual investments that make up our portfolio. The biggest chunk of our investable assets will be in exchange-traded funds, or ETFs. These form the core of our portfolio and are expected to provide an average annual return of between 7% and 10%. Please note that this doesn't mean we'll get a consistent 7% or 8% return every year. Some years might bring a 23% gain, while others could result in a loss. The key takeaway here is that, over time, holding onto an ETF, especially one tracking the S&P 500, tends to yield an average return within that 7% to 10% range. If you're wondering what an ETF is, it's like buying one fund that gives you exposure to everything the ETF invests in. For example, if you invest $10,000 in an ETF tracking the S&P 500 with the symbol VOO, you'll own a small piece of the 507 companies in the fund. There are various types of ETFs available, such as ones covering the entire US stock market, like VTI, or focusing on specific sectors like energy or real estate. In 2023, our goal is to allocate 40% of our total portfolio value to ETFs. So, if our portfolio were worth $10,000, $4,000 would be invested in ETFs. The next part of our portfolio is individual blue-chip stocks. These are companies like Google, Apple, Amazon, Johnson & Johnson, and more. They are large, stable, and expected to maintain their value over the long term. When considering a blue-chip stock, ask yourself if you think the company will still be around in 20 to 40 years. These stocks are known for their solid reputations, sometimes even paying dividends and consistent earnings. We typically look at companies with market capitalizations of over $100 billion, which excludes penny stocks and meme stocks like AMC Theaters. Some examples of such companies include AT&T, Salesforce, UPS, and McDonald's. For this part of our portfolio, we'll allocate 20%. So, if our portfolio were worth $10,000, $2,000 would go into blue chip stocks. Now, let's talk about the remaining 10% of our portfolio. This portion allows for some flexibility based on your age and risk tolerance. If you're younger, you might consider growth stocks or more speculative investments. However, if you're older, you might lean more towards fixed income, like bonds. Here's why we allocate only 10% to growth stocks. When interest rates rise, growth stocks tend to perform poorly. Many of these companies aren't profitable and rely heavily on borrowing, which becomes more expensive with higher interest rates. So, if a company's growth slows down or if it becomes less profitable, the stock's value tends to drop. We recommend that if you're under 40 and interested in growth stocks, you should research the companies thoroughly, focusing on their financial health, profitability, and market demand for their products. When it comes to bonds, you'll find options with yields similar to the 10-year Treasury note, which is currently around 4%. If you're on the opposite end and prefer a more stable, income-generating portfolio, you can allocate this 10% to bonds rather than growth stocks. Keep in mind that this isn't a one-size-fits-all plan. It's more of a guideline based on our approach for those aged 18 to 40 with consistent incomes. To recap, in this $10,000 portfolio example, over 90% of the funds are already allocated, 30% in cash, 40% in ETFs, and 20% in blue-chip stocks. The remaining 10% can be adjusted based on your age and risk tolerance. We suggest you create a list of your investments before making any decisions to help you guide your choices. This is our plan for 2023, designed to be somewhat conservative given the expected changes in the financial landscape. If your portfolio is currently heavy on growth stocks, it might be worth considering a more diversified approach to manage risks. Thanks for watching Master Wealth. If you like this video, please give it a thumbs up and share it with your friends. For more financial tips and strategies, subscribe and hit that bell icon so you never miss an update. We're here to help you on your wealth building journey. If you're interested in more videos from us, you can find the next video or set of videos recommended now. Stay tuned for our next video and keep working toward financial success with Master Wealth.